Welcome along to another DNC Investors Group explainer video. We are going to do a list of abbreviations, maybe words you might come across when talking business, and we're just going to give you a brief overview of what they mean and how they apply to business. So we're going to start with something that you might have heard in passing. It might be something you've heard for large corporations, but something that is appropriate to any business, and that is corporate restructuring.
Thanks, Danny. So a corporate restructuring to me, when I hear corporate restructuring, I hear the word redundancies. So a corporate restructuring is an action taken by a company that completely changes part of the company. It might be financial or operational. And it usually happens when a business is facing financial pressures. And so generally corporate restructuring has negative connotations and people can lose jobs in the process. However, the positive side of it is that the company will come through restructuring and be better set up for the future.
Perfect. And one of your favorite things to talk about, and that would be a cash flow forecast.
Definitely one of my favorite things to talk about. I'm obsessed with cash flow. And I'll explain first exactly what it is. A cash flow forecast, it's a tool that predicts the future flow of cash in and out of a business's bank account. It shows the projected cash based on income and expenses, and it's an important tool when making decisions on things such as funding, capital expenditure, investments, etc. A cash flow forecast allows a business to plan for the future and identify risks of negative cash flow. As a side note, it should be noted cash is the number one killer of businesses in the SME space. So you can have a highly profitable, well-run business that goes cash negative and has to liquidate if the cash conversion cycle parameters are not set up in the right way. If, for example, if you're paying your creditors before your debtors pay you.
Yeah. And we've seen many times where business owners have said, "Oh, I didn't do a cash flow because I thought it was guesswork, or I'm not sure how to do it." One thing I would say to you is, if first of all, give it a try. It's really important you have it there, whatever that looks like. Even if it's 70-80% accurate, it gives you an idea where you're going. And if you're not sure, reach out to Kian or myself, LinkedIn on the website. I would be more than happy to talk you through that. If we look at a phrase that's often thrown around, is a business stakeholder. Who is that, and what do they do?
So this is quite a wide-ranging phrase. A business stakeholder is any person, organization, business group that has an interest in the activities of that business, and it can either affect or be affected by the business's performance.
Perfect. Yeah, it covers a lot of bases, that one. If we talk about accounting methods, we'll hear people talk about accrual-based accounting and then cash-based accounting. What are they, and what are the differences?
So these are worth understanding. So the majority of businesses in the UK and across the globe use accrual-based accounting. So accruals are when expenses and income have been incurred, the transactions occurred, but the cash hasn't gone out the door yet. So that's how most companies do their financial statements. But the cash-based accounting is when revenue and expenses are only recorded when cash transfers. This is used for things like VAT returns, where a company will want to have been paid before they give their VAT to the government.
With you. And then if we talk about a balance sheet and a profit and loss account, what is that for anyone who's not clear on that?
So they form two parts of the annual returns that every company has to make. So P&L is generally for a 12-month period, and it shows the business's revenues and expenses over a specific period. And it shows the profitability of the company, basically. And the balance sheet is a report that summarizes the business's assets and liabilities to offer a one-time glimpse into the net worth of a business at that specific point in time.
Perfect. And if we move on to, we got the KPIs. most overused phrase in business.
Indeed. So a KPI, or a key performance indicator, is a metric that measures the effectiveness of a business, whether it's of actions, team members, business as a whole. It can be business or industry specific, or general indicators that are widely used as KPIs, such as revenue, uh, cost of sales, gross profit, etc., and it's used across many businesses.
What we tend to find with most businesses is they do have KPIs, some of them good, some of them bad. What you tend, as in, you can usually pick three, four, five key performance indicators that, monitored closely, they will tell you how the business is performing. Any more than that, and it just becomes unmanageable. If we talk about liability,
So liability is obviously has negative connotations. So it is by definition a debt or expense that a business is legally obliged to pay. It can range from salaries and bills to taxes and loan repayments.
perfect. And next on our list, we've got margin.
So the margin is the profit of a sale represented as a percentage after expenses are accounted for.
Perfect. So obviously, the higher the margin, the better. That's the idea. Fixed costs.
Fixed costs, they're costs that a business has to pay regardless of performance. Things like rent, utilities, salaries. In times of downturn, they can only be flexed by really, like, it's difficult measures. You have to make a structural change. Whereas with variable costs, I assume that's another one you want to talk about.
Next one on the
Variable
list.
costs are flexed based on your revenue coming in.
So obviously, if you've got large fixed costs and you have a reduction in your revenue, that can be a real problem, because there is, as Keane points out, very little you can do. If we talk about working capital, which probably leads us from our last point.
So working capital in its basic form is the cash needed to maintain day-to-day operations in the business.
Perfect. Gross income.
So gross versus net. Gross is total income before any costs, any discounts, any returns are deducted, whereas net is the income after your expenses, cost deductions, etc., have been accounted for.
Very good. We'll cover off a few acronyms, a few phrases that might pop up in conversation that you might have heard, you might not. POS.
POS is defined as point of sale, and it's time and place where a transaction is completed. It's an example of this in a supermarket.
Yeah, that's a good one. PPC.
Is a um, relatively new abbreviation. It means pay per click, and it's a form of digital marketing where you only pay if the user clicks on your ad.
Perfect. SEO.
SEO is another new abbreviation that we have to get used to with the introduction of Google, and it means search engine optimization, and is the process of enhancing your website in order for it to rank highly on those search engines.
Perfect. ROI.
So ROI is probably a phrase that all business owners know about, and it means return on investment, and it's measured as the ratio of net income to investment.
A number of business owners should be aware of, for every pound or dollar or euro they spend, how much are they getting back? It's a good metric. One of those KPIs that probably would be useful to know. USP.
So USP is your unique selling proposition, and I would think of USP as the reason why a business is different from its competitors, and it's the most important thing within a business. What do you offer that's going to differentiate you from everyone else?
Yeah, it's also a USP tends to be the reason why you can charge more for a service, whether that's you're the fastest to deliver the product, the highest quality, whatever it may be. that tends to impact on what your USP is. That covers most of the ones we had on our list. If there's any acronyms, any phrases or things that popped up in business that you're not sure about, do send us a message either via our website, LinkedIn, or wherever you're seeing this video, and we'll see you again in the next one.